Hello, and today we're going to take a look at bonds and how we are going to value them. And bonds are the primary instrument of debt financing that companies utilize to fund operations. We're going to go through some key features of bonds. How do we value bonds? How do we measure their yield? And also how do we assess their risk? So a bond is a long-term debt instrument in which a borrower agrees to make payments of both principal and interest on specific dates to the holders of the bond. Key features of the bonds are the following. All bonds have what are known as a par value. And a par value is the face amount of the bond which is paid at maturity. However long the term is of the bond will determine when that par value is paid. So usually it's $1,000, meaning after 30 years or 10 years or 5 years or however long the bond is, you'll get your $1,000 par value back. And during the time you held the bond, you probably earned interest payments as well. A bond has what is known as a coupon interest rate. It is generally fixed and it's paid by the issuer of the bond. And you multiply by the par value to get the dollar payment of interest. We have a $1,000 par value bond and it pays a 10% coupon rate. That bond is going to give you a $100 payment generally per year. Maturity date is years until the bond must be repaid by the company who ever issued it. The issue date is when the bond was created. And the yield to maturity is the rate of return earned on a bond that you hold until it is mature, also known as the promised yield. Other features of bonds. Bonds can be known as convertible or warrant bonds. Both of those we are going to cover in later chapters. In chapter 20 we go into convertibles and warrants. But convertible bonds can be exchanged for stock of a company at the holder's option. So if you hold the bond, you can exchange it for stock. A warrant is a bond that has stock options attached, which gives you the right to buy a stated number of shares at a specified price. So a convertible bond, you can convert that debt into equity. A warrant, you can utilize those options to buy stock shares and you get the warrant as part of your bond. A puttable bond allows the holder to sell the bond back to the company prior to maturity. So you can sell the bond. Not all bonds have all of these provisions. Some do, some don't. It depends on the type of bond and the policies of whomever issued it. And finally, what are income and indexed bonds? Income bonds pay interest only when interest is earned by the company, and index bonds, the interest rate is variable. It's not a fixed interest rate. They are varied based on the rate of inflation. So these are all different types of bonds you can encounter. Not all bonds have all of these features. Effects of a call provision. It allows the issuer to refund the bond if interest rates decline. So generally that will help the issuer but hurt the investor. So if you hold this bond and you're getting an 8% interest rate and rates go down to 5%, the bond may get called back from whomever issued it because they can issue new bonds for a lot cheaper. So it helps them, but it's not necessarily good for you. Generally, if your bond is callable, to agree to hold a callable bond, you're going to want a higher yield than a non-callable one. You're going to want something to sweeten the deal to make you be okay with holding a callable bond. Also, most callable bonds have what's known as a deferred call provision, meaning they can only be called back after a certain amount of time. They can't just be called back almost immediately if rates greatly fluctuate. And they have what is known as a declining call premium as well. And we'll go into all of these things as we take a look. So callable bonds do have protections in the sense that it's not going to get called back immediately. But if a bond is callable, one thing to realize is investors are going to want a higher yield than a non-callable bond. What's a sinking fund? A sinking fund is the provision to pay off a loan over its whole life rather than all at maturity. So it's similar to amortization on a term loan. It reduces risk to investor because bonds are being taken out of circulation, therefore it's shortening the average maturity. But it's not necessarily good for investors if rates decline after issuance, because bonds that are more expensive are being retired for ones that can be reissued at a cheaper rate. So how does sinking funds work? Generally, you're going to call a certain percent of the total issue of bonds at par value for sinking fund purposes. If you do that, you generally are in a situation where the return on debt is below the coupon rate and the bond is selling at a premium. When the return on the debt is below the coupon rate, and generally the bond is selling for more than par value. If you have the reverse, if the return on the debt is above the coupon rate, that means the bond is selling at a discount. Because to make up for that lower coupon rate, you're going to also make money on the bond itself. You're going to buy it cheaper than it's going to be worth when it's mature. So in that case, you would buy bonds on the open market. Because when bonds get called, they're getting called at par value. So if they're trading for more, than par value, you're going to call some of them back at par. If they're trading for less, you'll buy ones off the open market that no one is currently holding and retire those. So that's how sinking funds are generally executed. Remember, bonds are freely tradable like stocks. If you may have traded bonds before, if you do invest, and you can trade them through most major platforms, corporate bonds and the like, and they're pretty easy to trade. So they are often sold on the open market. What about the value of financial assets? So any financial asset, remember, its current value is what its cash flows are worth in today's money, and that's what we're looking at here. All these cash flows we're finding the present value of all of them at whatever the appropriate rate and time is. So that's how any financial asset works, bonds, stocks, etc. What's the opportunity cost of debt capital? So the discount rate is the opportunity cost of capital, and it is the rate that could be earned on alternate investments of equal risk. So what is this? This is the risk-free rate plus the inflation premium plus the market risk premium, default risk premium, and liquidity premium. So all of these get added in. And allows us to determine the appropriate discount rate. So what would the value be of a 10-year, 10% coupon bond if return on debt is 10%? So we know it's 10%. Coupon payments are also 10% as well. So we would find the present value of all of our coupon payments, and then the last year also the present value of our par value, which we're going to get back. And in this case, it's exactly par, or 1,000. We would generally use Excel to do this. So if we look right here, let's take a look. This is the same problem as slide 11, only now we're going to utilize Excel. So this bond has a $1,000 lump sum due at maturity, time 10, so 10 years, and an annual $100 coupon payment beginning at time 1 and continuing through time 10. Price of the bond can be found by solving for the present value of the cash flows. So we're going to enter into our formula. The formula we're going to use is the present value. Just like we covered in Chapter 5, we want what is this bond worth right now. And in this sense, N is 10 years, interest put 10%, payment is 100 because it's also paying a 10% coupon, and future value is 1,000, meaning in 10 years we're going to get $1,000 back. Now, present value, note, it's going to solve with a negative number, and that is correct because it means you would have to pay $1,000 for this bond, or a negative $1,000 cash flow, to get those $100 coupon payments every year and your future value of $1,000. So we're going to get our full par value that we spent back in 10 years, but we also got 10 years worth of coupon payments. Since this bond, the return on debt is 10% and the coupon rate is also 10%, it should trade at exactly par value. There's no difference between them, so it should trade at $1,000. So if this was a real bond and you purchased it, you're going to get yearly payments of $100 for 10 years and then get your $1,000 back, which is the equivalent of earning 10 years per year on your money. Now, what's the same bond, but let's say it had a higher coupon rate? Since the coupon rate is higher than the return on your debt or yield to maturity, this bond is going to sell at a premium because you're going to get more coupon payments than the overall return on the bond. So coupon payments here are $130 due to a 13% coupon rate. The only difference here is same formula, just instead of putting 100 for payment, you put 130. Otherwise, everything else is the same. And as you note, the present value of this one is negative $1184.34, meaning you're going to have to spend $1,184.34, and you're only going to get back 1,000 of it in 10 years. But why would you be okay with doing this? Because you're getting larger coupon payments. You're getting $130 instead of $100. That's going to make up for the difference between the present value and the future value of the bond. So you're going to have to pay more than par value for this bond, but you're going to get much larger coupon payments, and you make the same 10% per year. So this bond or the previous one, you're going to wind up making identical returns. One was going to cost you more upfront than the other one, but you're going to wind up making the same returns if you hold this bond over its whole life. So slide 12 and 13, you're going to make the same return of 10%. One of them is going to cost you more, but also pay larger coupon payments. Conversely, let's do the same thing. 10-year bond, same return, but this one pays small coupons. Since it's $70, risk is the same, it has the same yield to maturity. As a consequence, you're going to get this bond at a discount. The reason you're going to get it at a discount is it's paying a lot less of a coupon payment. So it's going to have to trade under its par value to make up the difference. You're going to make money both on the price of the bond and off of the coupon payments. So this one's only going to cost you $815.66. You'll get much smaller payments. You'll still get that future value of 1,000, and the yield to maturity is still 10%. So even though this bond has a smaller coupon rate than the previous one, it is going to make up for it by trading under par value. So bonds, the prices of them do float in real time, so the relationship between the coupon payment and the overall prevailing rates is important. It's going to change the price of the bonds. So if a bond is selling at a discount, it's paying less of a coupon rate than its yield to maturity. If it's selling at a premium, it's paying more of a coupon rate than its yield to maturity. Over time, bonds do change in value. And as we approach the end of the years to maturity, both the bond paying the 13% and the 7%, their value is going to come closer and closer to par. The 7% one will become more expensive, the 13% one less, because there's less and less time for those differences in coupon payments to matter. And then at 0 years to maturity, they will all equal par value. So all three of these bonds in the end will equal that same par value of $1,000. So over time, the value of any bond must equal its par value once it becomes mature. So if the return on debt is constant, the value of a premium bond, as we saw on the previous slide, is going to decrease until it reaches $1,000 when it is mature. The value of a discount bond is going to increase until it also reaches $1,000 when it's mature. And the value of a par bond will stay at $1,000. So that's what happens to bond values over time. What is the yield to maturity on this following bond? And there's a nice formula we can use, and we're going to use Excel to do all of these. So even though you can use these formulas, that it is showing you, I would highly recommend utilizing Microsoft Excel for all of the calculations. It just makes everything a lot more simple. So in this case, we're going to look at a 10-year maturity bond, 9% coupon, so it'll pay $90 per year in payments. $1,000 par value, selling for $887. What is going to be our appropriate yield to maturity or return on debt? So if we look right here, we're going to use Excel once again. Our formula is going to be equals rate, and then we're going to put in the following information. Number of years in this case is 10. Our present value is negative 887. Be sure to enter it as a negative number because, once again, we have to purchase this bond when we start, so it's going to cost us money. Payment is $90 positive every year. It's going to make us profit. And then our future value is 1,000. That will be positive because once the bond is done, once it's mature in 10 years, we get a $1,000 check back from the company we purchased the bond from. If you put all of this in, your interest per year should solve to just under 11% or about 10.91%. And that is the appropriate yield to maturity. Anytime you want to find the yield to maturity for a bond, your appropriate formula is going to be equals rate. Equals rate. And that's going to be the one we utilize in Excel. Now we're going to do the same thing, only this is going to be a bond selling at a premium. If a bond selling at a premium, coupon rate is going to be greater than yield to maturity. So let's take a look at this one. Once again, 10 years total time for this bond. Present value, put in 1134.20. Just be sure to make it negative because once again, that's what it's going to cost us. Payment is still $90 because all we changed here is the bond price. Future value is still 1,000. Unless it states otherwise, the par value is something else. The overwhelming majority of bonds are a par value of $1,000. So unless some other thing is stated, that's going to be pretty much the default for a bond. And once again, our formula is going to be equals rate. If we use this formula and put in all of the particulars, we're going to get an interest of 7.08%. 7.08%. And that is going to be our yield to maturity. So 7.08% is going to be our yield to maturity, and that is going to be our appropriate rate of interest on that bond. We can look at some terminology that applies to bonds as well. We have what's called the current yield, which is just simply your annual coupon payment over the current price of the bond. That's why it's known as the current yield. We have the capital gains yield, which is have we made anything positive or negative on the price of the bond itself. So we divide the change in price from when we purchased the bond till now over the beginning price. And that's just simply going to tell us have we made anything or not on the value of the bond. If the bond is still trading at par and we bought it for par, your capital gains yield would be 0 there. If it's trading for less than par or more than par, you could get a positive or negative capital gains yield depending on the situation. Your expected total return is the same thing as the yield to maturity which we were calculating, and yield to maturity is simply your current yield plus your capital gains yield. So the coupon bond that we just looked at, paying $90 coupons or 9% interest on the $1,000 par, it's selling for $887. A current yield would just be divide those a little over 10%. 10.15% is your current yield here. Capital gains yield, however, is going to be the difference between our yield to maturity minus our current yield, in this case 0.76%. Remember, yield to maturity is your current yield plus your capital gains yield. So since we know both the yield to maturity, we found that before, and we know the current yield, a little under 1%, 0.76% is our capital gains yield. You could also find the expected price 1 year from now and divide the change in price by the beginning, and you would get the exact same answer here. One thing bonds are subjective to is what is known as price risk. And price risk is the risk that you lose money because the price of the bond changes a lot or maybe more than you would expect. So price risk is concern that the rising return on debt will cause the value of a bond to fall. So 10-year bonds are more sensitive to interest rate changes and have more price risk. Pretty straightforward. Remember, bonds approaching their maturity, even if the interest rates are very different from the coupon rates, they're going to trade near par because they have very little time left. Bonds with a lot of time horizon remaining are much more sensitive to changes in interest rates, and the price can vary accordingly. Looking at a 1-year bond ranging from 5 to 15% return on debt or cost of debt, interest rate pertaining to debt here, 1048 to 956, whereas the 10-year bond will run from 1386 to 749, just because there's so much more time remaining. So if interest rates widely change, the price of your bonds are going to widely change as well. So you can actually lose money as a consequence if you have a lot of price risk. Your bond can be worth a lot less than you may have paid for it, for instance. Yes, it's still going to pay coupon rate, still going to make coupon payments, but price risk is an important thing for especially longer term bonds. As we look here, the 1-year bond has obviously a lot less price risk than the 10-year one, just due to time value of money. That's pretty clear why that is the case. So price risk is the risk that the price of the bond changes a great deal from what you may have paid for it or from par value. What is reinvestment risk? Reinvestment risk is concern that return on debt or cost of debt is going to fall, and future cash flows will be reinvested at lower rates, reducing income. So let's say we won $500,000 playing the lotto and we want to invest this money and try to live off the interest. How would reinvestment risk come into play here? So we can take our $500,000 and invest in either a 10-year bond or 10 one-year bonds. Both of them are currently yielding 10%. So in theory, we should earn $50,000 per year in interest by doing this. But if we choose the 1-year bond strategy, after year 1 we'll get $50,000 in income and we have $500,000 to reinvest. So we live off the $50,000 in income, we take our $500,000 and we're going to invest it again. But if 1-year rates fall to 3%, your annual income would drop to $15,000. We're going to have a tremendous amount of reinvestment risk. So since we only locked up our money for a year, if we reinvested a year later and rates drastically changed, we're going to have a great deal less income. But if we can lock in a 10% interest rate and $50,000 annual income for 10 years, that's going to be much more predictable. You see this all the time with bonds and other types of investments. Certificates of deposit, CDs are like this as well. The longer term ones are more stable, but the shorter term ones may pay a higher interest rate to make up for the fact that they're more volatile. So in this case, if you had a choice and the rates were the same, if this was your strategy and you wanted to live off $50,000 a year, you'd be much better off with the 10-year one because you would eliminate that reinvestment risk. However, you wouldn't eliminate it fully because if rates go up, you obviously could have made more money. But you're going to certainly eliminate it from going the other way. You're going to eliminate losing any potential income in the sense that rates might drop and you would get less income if you didn't choose the longer strategy. What are some conclusions about price risk and reinvestment risk? Short-term or high coupon bonds have pretty low price risk, but they have high reinvestment risk due to the short term. Long-term and or low coupon bonds, high price risk, but generally low reinvestment risk. So it's a trade-off. It is definitely a trade-off. Long-term bonds, you have a lot more price risk, but a lot less reinvestment risk. The short-term ones are the opposite. If we want to look at a semi-annual bond, some of them do this. You would multiply your years by 2, so now we're doing semi-annual periods. So if it was a 10-year semi-annual bond, N would be 20 instead of 10, and you divide your interest rate in half and cut your coupon in half as well. So let's take a look at this on the following slide. So in this case, we have a 10-year, 10% semi-annual coupon bond. Return on debt is 13%. So number one, we have to set N here to 20. The reason we make it 20 is it's now 20 semi-annual periods. Interest per year instead of 13%, enter half for 6.5 because it really means 6.5 per semi-annual period. We know we're going to get a $100 coupon per year because it's a 10% bond. So enter 50 as your payment because we are doing semi-annual. Future value is still $1,000. We still get our par value back at the end of the 20 semi-annual periods or 10 years. And we are going to find our present value. It's the same PV formula that we used before, just 20 instead of 10. Cut your interest rate in half, cut your coupon payment in half. And you get a present value of $834.72. Present value of $834.72. So if we were an investor, what would we prefer? Would we prefer a 10-year 10% coupon bond or a 10-year 10% semi-annual coupon bond? Remember the formula that we looked at equals effect. Equals effect tells you the effective interest rate. And due to compounding, anytime you have semi-annual compounding, it's going to give you a slightly higher rate than annual. If you want to use that formula, the formula is once again equals effect. Interest rate goes first, so enter 0.10 or 10%, and number of periods of compounding second, enter 2, meaning it's semi-annual, and you get an answer of about 10.25, 10.25%. That means that effectively you're making 10.25% yield instead of 10%, which is the annual bonds rate. So if given the choice and they have the same nominal rate, you're always going to prefer more compounding periods. For the same reasons as a bank account or anything else, you'll get a higher rate of interest because of that extra compounding. So you would prefer the semi-annual bond for that reason. You're getting more money earlier. It's going to give you a higher effective rate. If the proper price for the semi-annual bond is $1,000, what would we expect the price for the annual coupon bond to be? So the semi-annual one is a 10.25 rate. The annual one should earn the same. So the annual and semi-annual would be in equilibrium in this sense. So if we put in 10.25%, what are we going to get here? We'll get a present value of $984.80. So the annual one, $984.80 here. Once again, equals PV. In this case, since it's annual, 10 years, the 10.25 is our interest rate. Payments 100, future value is 1,000. And we're using, once again, the present value formula in Excel, equals PV. 10-year, 10% semi-annual bond selling for $1135.90 can be called for 4 years at $10.50. What's its yield to call? Yield to call is what the bond yielded from the time you held it till it got called. Remember, if a bond gets called, its issuer calls it back, they retire it, and they pay you out your par value. As you can see here, this bond can be called for 4 years, not at par value, but at $10.50. That's an example of a call premium. A call premium is going to basically give a little bit of a sweetener. It's more than par value. So if the bond does get called, you're going to get a little more money than you would have, and that is what is known as a call premium. And once again, most bonds that are callable generally have provisions in them that they can only be called after a certain amount of time. So as we see here, this one can be called in 4 years. So most callable bonds can't be called immediately. They have at least a minimum threshold that has to be met. So we're looking at our yield in 4 years' time. Bonds yield to maturity is 8%. Solving for the yield to call is identical to solving for the yield to maturity, except the time to call is used now for N. Call premium is future value. So what are we going to put in here? Since this is semi-annual, and we want to find the rate, so we're using equals rate as our formula, N is 8. Instead of 4 years, 8 semi-annual periods. We put in for PV what the bond costs right now, which is $1135.90. Make sure it's negative, because once again, that is going to be an outflow. You have to buy the bond. Cut the coupon payment in half. Since it's 10% and it's a $1,000 bond, coupon payment's $50. Future value is not $1,000, but it's $10.50 because there is a call premium. You're going to get more money than you would have had it been called, not called, but had it been retired at maturity because it got called earlier. So put all of that in, and what do you get? You would get a yield to call of 3.568%. That's what you would make if the bond got called, 3.568% interest per year, and that would be your call. That would be your call here. Actually, that should be interest per semi-annual period, and then you would double it. So in this case, that would be our yield to call. That would be our yield to call. And yes, if you look right here, 3.568 is your semi-annual yield to call. So since we were looking in semi-annual, Excel did everything correct. However, it gave you interest per period. If you want your yield to call, what would we do? We would double it. You would get 7.137%, and that's what a broker would quote. Why? Because that's per semi-annual period. We have to double it for the annual one. If you want the effective yield, so a broker would just double it and quote the nominal one. The effective yield, remember, is going to be a little bit higher. You would once again use the equals effect formula. So type in the 7.137% up first, 2 compounding periods, and you would actually get a little better, 7.26%, due to that point. So the effective rate's a little higher, but the rate that would be quoted by a broker that is selling you the bond or advertising the bond would just simply be the nominal rate doubled. So that's our semi-annual yield to call. We have to remember double it. Excel solved it correct, but it's giving it per semi-annual period, not per year. We're going to have to double it as a consequence. So a little over 7% would be our rate if we didn't have the bond its whole time. So obviously it's less than you would have earned had you held it its entire time. Had you held it its entire time, it was a 10% couponing bond. Since it got called, you wound up making less than that. So obviously when a bond gets called, it generally helps the issuer more than the bondholder. That's why call premiums and things like that are baked in. So if you bought the callable bonds, would you more than likely earn the yield to maturity or the yield to call? Coupon rate is 10%, yield to call 7.137. The firm could raise more money by selling new bonds which pay the 7.137. So you could replace bonds paying $100 per year with ones paying only $71.37, and investors should expect a call and earn the yield to call of 7.137% rather than the yield to maturity of 8%. So since they can replace these bonds with ones that will pay less of a coupon rate, it's going to save them money, and as a consequence, investors should expect the yield to call. So if a bond is callable, there is a good chance your bond does get called back before its before its maturity expires. When is a call most likely to occur? Pretty straightforward. If a bond is selling at a premium, then coupon is going to be greater than return on debt. So one coupon is greater than your return on debt, so a call is more likely. If a bond selling on premium, expect to earn the yield to call more than likely. If it's selling at a discount or at par, then you would expect to earn the yield to maturity. Generally, bonds that are selling at a premium, meaning they're paying a higher coupon rate than the prevailing interest rate in the market right now, those are the ones that are generally going to get called. They're paying a higher interest rate. So even though you are going to earn whatever the return on the bond is, since you had to pay a premium, the company who issued it is paying a lot higher coupon payments than they would need to if they issued new bonds. So that's why it's in their interest to call those bonds back, because they're paying a coupon rate that may have been appropriate 10 years ago, but if interest rates dropped heavily or something like that, they are going, as a consequence, to probably call that bond back. A heavily discounted bond, meaning this would be a situation right now, a bond was issued 5 years ago when interest rates were 2%, and it's paying very small coupon payments, 2-3% or something like that. Now, prevailing rates are a lot higher. A company would never want to call that bond back, because by doing so, they would have to issue new ones that pay a much higher rate. What about default risk? If an issuer defaults, investors are going to receive less than the promised return. So investors are going to be getting less than the promised return. Therefore, the expected return on corporate and municipal bonds is generally less than the promised return. And it's generally it's generally influenced by a issuer's financial strength and the terms of the bond itself. I will take a look at that in a moment. Bonds get what are known as credit ratings. So just like you or I have a credit score, companies get a credit score as well, and they're known as a bond rating. So good bonds, the more A's, the better. So Moody's and S&P are two examples. Fitch is another rating agency. So AAA bonds are your best, then AA, single A, and then Moody's has BAA or triple B at S&P, and those are the lowest investment grade. Investment grade is considered pretty stable. So corporate bonds are always going to be riskier than government bonds, but if it's considered investment grade, it's probably being issued by a pretty strong company. So all of the major companies you know, are generally investment grade. And then you have, and you may be familiar with the term, junk bonds. Junk bonds are generally issued by very risky companies. They could be companies that are young, that are struggling to get started. They could be companies that are in very bad financial shape. So it runs the gamut of why a company may have a junk bond rating. But if a company is rated junk bonds, which is less than BA or BB, depending on who issued it, those mean that they are very risky, and there is a high chance that they default. What's going to happen if a company has to issue junk bonds? Why would you want to hold a bond that's got a high chance of default? They're going to make it attractive by paying a very high return. So junk bonds generally pay much, much higher returns if you hold them than investment grade bonds. Because it's going to make up for the fact there's a much higher chance this bond defaults, and if they do, you might lose some, if not all of your money. So as a consequence, you're going to get a much higher rate of return than an investment grade bond. Some risky tech company that's heavily indebted that you may not be familiar with is going to have to charge a pay a much higher rate to its creditors than a company like Apple or Microsoft or tech companies that have billions and billions of dollars in assets. Microsoft and Apple are some of your most stable companies that can borrow at very low costs of debt compared to companies in similar sectors that are very risky. So bond ratings are designed to reflect the probability of an issue going into default. The lower the rating, the more likely that the company does indeed default. Factors affecting default risk and bond ratings. This is pretty straightforward. Debt ratio. If a company is very heavily indebted, the company is a much higher default risk. Also tie and current ratio as well. Qualitative factors, secured versus unsecured debt. Secured debt means that it's backed by something. If the debt issuance defaults, it could be backed by physical property or assets or something like that, meaning that can then get sold to pay out the debt holders. Secured debt is much safer than unsecured debt, meaning if the debt defaults, you're left holding the bag, or the company goes bankrupt and you get something back. But secured debt is more stable. Senior versus subordinated debt. The more senior the debt, the more likely you are going to get paid out if the company fails. So really senior debt comes up earliest in the order of liquidation. The more subordinated the debt is, the less likely you are going to get your money back. Guarantee and sinking fund provisions, remember, they make the issuing of the debt safer because it's removing some of the bonds every year or period or quarter or whatever the provisions are. And also debt maturity. How long-term is the maturity on this debt? Longer term debt is riskier. If the debt has a 30-year maturity or something, that by definition is a lot more risky than something that might be a year maturity. It's pretty easy to predict what a company is going to do over the next year, barring some very freak thing. But for the most part, it's a lot easier to predict how a company is going to do in a year or 2 years than 30 years out. Even the most successful companies 30 years ago, plenty of them are gone today. So just time alone makes a bond a lot more risky. Other factors affecting default risk, miscellaneous factors such as how stable are a company's earnings. Does the company make stable, large earnings every year? So are they Apple? Are they super highly profitable and they're going to make billions every year in profits from their products, and you can pretty much guarantee that Apple's going to have a good year on top of a good year. Some might be better than others, but their earnings are very stable. Whereas you might have a risky pharmaceutical company that if they make a new drug, they might make ridiculous earnings, but then have very little earnings for the next cycle where they develop another drug. That's a lot more risky. Does the company face any lawsuits from the government for being a monopoly or anything like that, antitrust lawsuits? Are they facing any legal liabilities from products? So did they release a product that hurt people or had any kind of lawsuits attached to it? If they did, obviously that's going to be a lot more risky because they can face large consequences or monetary penalties, anything like that. What are their pension liabilities, meaning what kind of money do they have to pay out to former employees or retirees? Do they have a large amount of unfunded liabilities there? And what about labor problems? Are they going to have a labor force that goes on strike or maybe not be able to replace their workers? Maybe they have a specific skill that is getting very hard to find. This is all stuff that can determine how risky a company is perceived to be. And there's no perfect way to do this. A lot of this, once again, is subjective. We use our best knowledge to rate companies, and that's how ratings agencies do work. But it's never perfect. You have certainly seen companies that had good ratings get into financial distress and possibly default, and plenty of junk bond issuers make good on their junk bonds. So you can make a lot of money investing in junk bonds. It's just highly risky. So like a lot of risky investments, the chance of a reward is higher, but also a lot more risk. What happens if a company cannot meet its obligations? This is a term you may have seen before. It's known as Chapter 11 bankruptcy. So if a company cannot meet its obligations, it's going to file something known as Chapter 11. They file this with bankruptcy court, and it stops their creditors or their bondholders and whomever they owe money to from foreclosing, taking assets, and shutting the business. And it's going to give them a little bit of a break. If you file for Chapter 11, it doesn't mean you're broke yet. It means that you can't meet your obligations right now, but you think you can fix the company. And it gives you 120 days to file a court-supervised reorganization plan. The bankruptcy court, is going to appoint a trustee to help work with the company and supervise its reorganization. Management stays generally in control for that 120 days. And during that time, they're going to do things like negotiate with their creditors. So they'll tell their bondholders, we may not be able to pay you this coupon rate right now. Would you agree to less of a rate? Or would you agree to, we miss a few payments and then resume, or anything like that? Once again, you're going to negotiate with your creditors. And during this time, the company must demonstrate its reorganization plan and that it's worth more alive than dead, meaning they're not so broke and they're not so dysfunctional that if they get a little help from their creditors, if they're able to reduce their cost of debt or structure it in a way that maybe they don't have to pay back anything for a few more years and then they can resume paying and kick the can down the road a bit to reorganize. If they can do this and prove that the company's worth more money existing, generally your creditors are going to agree to this. Because what's the alternative? If the alternative is your company is completely broke and there's no way to save it, they're going to lose a lot of money. Bondholders generally will get something back. It's the stockholders that generally get nothing because stock is last in the order of liquidation. We're going to look at that on the next slide. But even if you get something back, it may only be pennies on the dollar or 50 cents on the dollar. So your creditors are going to lose money. It's not in their interest for us to fail if we're a company in Chapter 11. However, not all companies that enter Chapter 11 can be saved. If a company is so heavily indebted or so dysfunctional, or they are not profitable in any way, shape, or form. So there are companies that are profitable, but they may have so much debt on them, they go into Chapter 11 to get some of this debt reduced. In that case, Chapter 11 generally works. Whereas if a company is making no money, they have products that no one wants, or they are just so dysfunctionally run that they aren't making any money and they don't see any path to make money again, then you're going to get what is known as Chapter 7, which is going to be the order of liquidation. It will get ordered under Chapter 7, and then a company, I believe, enters Chapter 13 bankruptcy. So what that means is the company is then going to get scrapped. It'll get broken up, and generally the court will sell off any valuable parts. So if the company owned any kind of assets, they'll get sold. Any valuable intellectual property, trademarks, anything like that will get sold, to try to recoup as much money back to pay off whoever held bonds, and what we're going to see on the next slide. And that is the order of liquidation. So if a company is broken up, it enters Chapter 7 bankruptcy, and it is liquidated, here is our priority of claims. Up first are what are known as secured creditors, and secured creditors are your creditors who had bonds that were backed by something. So you bought bonds or you gave a loan and that was backed by a physical building or some sort of asset held by the company. You're going to get paid from those assets that were securing the debt there. So secured creditors go first. After them, any costs by the court, so trustees' costs, the trustee appointed by the court, they get paid. Then your wages get paid. So obviously you owed money to employees. They can be subject to limits, but you're going to have to pay out unpaid wages to certain limits and certain stipulations. Once again, this is all agreed upon by the bankruptcy court and as the company's being broken up. After wages, so after you make good to your employees, we're going to pay out any taxes we may have owed. Then any unfunded pension liabilities. Then unsecured creditors. So you can see why you want to be a secured creditor. They're number 1, whereas unsecured creditors like a generic bondholder, they're number 6. Then preferred and common stock. Your stockholders generally get very little to nothing depending on how the assets of this company were. Bondholders generally at least will get something. It may be pennies on the dollar, but stockholders will very rarely get anything if a company is broken up. They may, depending on what the assets were, but they are last on the list. Because they are considered owners, they are not considered creditors. So if you're the owner of a company that goes broke, you're going to be last on the list to get any sort of money back. All of the creditors would have to be paid first. So that's the priority of claims in a liquidation situation. And finally, reorganization. Why is it important? Because in a liquidation, unsecured creditors generally receive nothing or very little. They'll get pennies on the dollar at best if they're unsecured bondholders or creditors. And it's going to make them a lot more willing to participate in reorganization, even though their claims may be scaled back. You may lose your coupon payments or get them greatly reduced, but you would still rather get your par value back than get 0 or get 5 cents on the dollar or anything like that. So as a consequence, you're going to want to make sure that you try to work with the company and keep them going, because it's in your interest that you get as much back as you can. Various groups of creditors will vote on the reorganization plan, and if the majority of them and the judge signs off, well, then the company is going to emerge from bankruptcy generally with less debt, reduced interest, and a chance for success. So Chapter 11 is often successful. It doesn't mean a company is never going to function again or they're permanently broke. It means that they're going to try to work with their creditors to reduce their debt and also reduce their interest charges and be able to chart a course forward. Obviously, this does not work for every company because there are situations where companies just simply wind up going bankrupt. What that means is they cannot find a way forward and the judge will order the company broken up. But that really isn't in the interest of anyone, because if there is a way for the company to continue to exist, it generally winds up as a much better scenario for everyone involved than simply shutting down. So that is all about bonds and also about defaults and Chapter 11 and all of that stuff. And that is going to take us to the very end of chapter number 7.